Tools of monetary policy. Tool number 2, overnight reverse repurchases. This is a bit of a mouthful, so for short, people use repo. In this situation, the Fed will borrow overnight, so a very short period of time, from financial institutions for a given interest rate, which we call the ORR rate. These financial institutions are not banks, and they are not part of the Federal Reserve System. And so this is a different system used by the Fed to influence the lending of these institutions that are not members. Step 1 of this process, the Fed is going to sell some bonds or treasury securities to a financial institution worth about $1 million, for example. Let's pause for a second and define what treasury securities or securities in general are. They are an obligation of debt issued by the U.S. Treasury, so the U.S. government. It is an IOU, to make it simple. So for instance, let's say you buy a U.S. Treasury, because anybody can buy treasuries. It is like you lending money to the government. Let's say you buy a treasury security for $100, you're lending $100 to the federal government. In return, the government will pay you interest every quarter, every year. And when the life of the security is over, they will pay you the initial amount. So you get your $100 back. So you have many types of treasury securities. You have bonds, treasury notes, treasury bills, treasury bonds, inflation protected securities, and they are all different because of usually their life cycle or sort of maturity. The notes, for instance, are for 2 to 3 or all the way to 10 years and pay interest every 6 months. Treasury bills are shorter term. They go from a few days to 52 weeks. And the bonds go from 6 months to 30 years. So there are various types of IOUs for the federal government. Okay, so let's go back to our example. So the Fed sold some of these treasury securities to this financial institution, and so some cash goes from that financial institution to the Fed. Step 3, which happens the next day, the Fed will repurchase the securities. And step 4, the Fed will give the $1 million back plus some interest. And so that is the interest, which we call the overnight reverse repurchases interest, ORR interest rate. Okay. So this sort of complicated operation is a way for the Fed to influence the lending from these non-bank financial lending institutions. It's an additional tool to influence the federal fund rate, and it is a way for these financial institutions to earn some interest. So what the Fed is trying to do here is, influence the lending. So, for instance, if the Fed is giving an interest rate of 4% to these institutions, and the federal fund rate at the same time is 3%. So this institution here, the institution here has a choice. They can buy the bonds from the Federal Reserve and receive 4% interest on it, or they can lend to this other bank and get the federal fund rate for 3%. So in this case, this financial institution is more likely to choose the Fed option because they will earn more money that way, more interest, and it's guaranteed. The Fed will always pay their bills, so it's an easy money to be made. And by doing this, what the Fed is doing is it's kind of preventing some lending to happen, preventing from this financial institution from lending money to other banks or to their own customers for that matter. And the Fed will do something like this if it wants the lending to decrease. And when there's less money available for lending, the interest rate will tend to go up. So the federal fund rate will tend to go up, which will discourage lending even further. So by giving interest on excess reserves or on overnight reverse repurchases, what the Fed is doing is establishing a minimum floor interest rate. That, in the sense, it means that the interest rate, that is the interest on excess reserve or on the overnight reverse repurchases, is the guaranteed minimum that a financial institution or a bank can earn. Right? And so by doing that, the Fed is setting the assurance that the interest rate will not go lower than this interest on excess reserves or the interest on overnight reverse repurchases. And so if the Fed is raising the interest on excess reserves or raising the interest on the repurchases, it's raising the minimum interest rate in the economy, and it means that all the other interest rate will also increase. If it lowers the interest on excess reserves or the interest on the repurchases, it means that it's lowering the minimum interest rates, and all the other interest rate, the federal fund rate and the others, will also go down. Here's a graph that shows you how all these interest rates kind of follow each other. So first, look at the blue line here. So this is the federal fund rate. This is what the Fed is influencing. Right? The red line represents the bank's prime loan rate. So what this is the best interest rate that you could get from your bank, which is usually reserved for their best customers that have the highest credit rating. They get this one. Everybody else gets this plus something. Sometimes you'll see on your loan, for instance, if you get a loan from a bank, it will be prime rate plus something, plus 5%. So this is how the banks do it. They have a minimum premium on the federal fund rate, and plus, if you are a riskier customer, there's even a greater risk premium. When you look at these two lines, you can see that they kind of follow each other, right? If the federal fund rate is increasing, the prime rate is increasing. When the federal fund rate goes down, so does the prime rate. The difference between the two is not always the same, but they tend to increase and decrease together. And that's how the Fed, by influencing the federal fund rate, also influences the prime rate and all the other interest rates in the economy. Here's another example, the interest rate on auto loans. in green over here. And you can see that it is not as precisely, but it is also kind of following the ups and downs of the federal fund rate and the prime rate. So by setting the federal fund rate and setting the minimum interest rate in the economy, the Fed is able to influence all the other interest rates in the economy.